On today's hot sheet, I'm discussing luxury home prices and the BLS Employment Situation Report. I'm taking your questions live as well. Today is Friday, February 2nd, 2024. I'm Byron Lazine, and the hot sheet starts now. Welcome back to the Hot Sheet, free format Friday edition of the Hot Sheet. If you're joining me live, let me know in the live chat which market you're tuning in from. I'm here in my Connecticut studio and happy to be with you on this free format Friday. It's been a big week kind of in real estate. We had a Keller Williams settlement yesterday on the Sitzer Brunette lawsuit. They settled for $70 million. We finally had the interim CEO of NAR release a video. We had a Jerome Powell week. If you missed the Jerome Powell breakdown from yesterday, that is the hot sheet to go back and re-listen to or re-watch. It's packed with a whole bunch of information. That was Tuesday, we had the Elizabeth Warren letter to the FOMC. There's just been a lot going on. And so if you've got any questions or comments or direction you'd like to take it on this free format Friday, feel free to drop it in the chat and I will address those comments before we sign off. But first, let's get into this new Redfin report press release from yesterday. Was it yesterday? Yeah, no, it was from the day before on the luxury real estate market. Right now, the typical luxury home sold in the fourth quarter for a record $1.17 million. So not only do we have a peak pricing across the country on residential homes, we are also experiencing a peak pricing in luxury homes. I will say that I did not expect that. If you asked me in the beginning of 2023 if luxury homes would set a new all-time peak, I would have said no. I would have imagined in a slowing economy, which obviously the economy didn't end up slowing. It was very robust last year by all metrics, right? But if it were to be a slowing economy, I would have expected luxury home prices to pull back. That kind of would have been my guess or intuitions there going into last year. That didn't happen at all, of course. And in the fourth quarter, luxury homes were up 8.8% from the year earlier. So luxury home now pricing at 1.17 million across the country. That might be different in your market. Okay, every market has a different barometer for what luxury homes are. It could be $500,000, $750,000 in a market where $1 million might be an average price point in other markets, and you might have to cross over the $5 million threshold for it to be considered luxury. Prices of non-luxury homes obviously increased as well, but at half the pace in the fourth quarter, according to Redfin, at 4.6% year over year, also to a record of $340,000. This is according to analysis that divided all U.S. residential properties into tiers based on the Redfin estimates of homes market values as of January 2024. Redfin report defines luxury homes. So this is how Redfin is defining luxury home, as those estimated to be in the top 5% of their respective metro area based on market value. And non-luxury homes is those estimated to be in the 35th to 65th percentile based on market value. Okay, so luxury home in your market, top 5%, what would that be? What would the top 5% of market value homes, what would that average be in your market? What does luxury look like? What's the price point there? Again, that can differ in every single market, but nationally, they've got a record in the fourth quarter at $1.17 million. We'll get into some of these price points, but luxury homes are rising now at twice the pace of non-luxury prices. And you can see here, fourth quarter, that just completely throughout the year here, 2023, really up and to the right, and now kind of topping off and dipping down, while non-luxury homes are shown to continue to move up 4.6%. And here's when we go to let's go to this one here. This one's interesting. New listings soar. All these downloads will be available for you in BAMX, so you can get all the slides in BAMX. When we look at new luxury listings, a better bet would be this year to say, luxury prices have probably pulled back this year. Last year would have obviously been wrong, but when you see Listings jump up 19.7%. Non-luxury is down 3.3% on new listings. We need new listings. This also tells us, because Altos research is showing us that new listings is up in January, right? Year over year. Well, non-luxury, according to Redfin, is down 3.3%. So what type of inventory do we actually have on new listings across the country? Looks like the majority of it is in luxury, which isn't an affordable option. So if we see nationally now, this is interesting. When we look at nationally inventory, ticking up a little bit, we're like, okay, that's a good sign. Bottom's behind us. I keep talking about that all month in January. Bottom's behind us. We're seeing inventory tick up. We're seeing new listings finally tick up. Well, if the majority of that inventory and new listing data is luxury, like Redfin points out here, that's not really going to be helpful to home prices. If non-luxury homes, new listings are actually down year over year, 3.3%, that would be a case that non-luxury median price point homes in your market are going to go up in price this spring. It's important right now as a buyer agent, if you're making offers on the behalf of your client, that you're very upfront and straightforward with that client about their ability to win the deal now. Because if you're in one of these markets that prices are going to go up in the spring, if you let them make October offers when rates were at 8%, meaning low ball offers, we're gonna cost them money if we let them make those 10,000 below where the price is really going to sell, or 20,000 below where the multiple offers are really going to come in at. You're going to cost them money because they're going to keep stacking up L's on the board through the spring market, and then they're going to get to the end of the spring and it's like home prices are up another 5%. Yeah, it's a better investment now to pay the extra 10, win the deal, and avoid the heavy competition that could be coming in the spring market, especially if this number is true that Redfin's reporting here, where non-luxury new listings are actually down year over year. That'll make it even more competitive for the buyers that are going to be out there shopping this spring. Total luxury inventory, okay? Total luxury inventory up 13%. So again, we've seen luxury go up according to Altos research, which we cover every single Monday here on the Hot Sheet. Make sure you subscribe so you don't miss any of these live hot sheets. And total inventory's up on the year. But if 13% is luxury and non-luxury is down negative 9.7%, which is what Redfin is reporting here on total inventory, then that means the majority of the inventory that we're looking at as being up nationally is at price points that most buyers can't afford. Okay, if luxury in the fourth quarter defined by Redfin was 1.17 million, a record price, how many of your buyers can afford that? Okay, maybe if you're in New York City right now or Beverly Hills, you're like, well, all my buyers can afford that. That's the bottom of the market. But for the rest of us, everybody else in America, generally speaking, 1.17 million is going to be a smaller segment of the buyers that you're working with, of the consumers and the leads that you're generating in your market. 1.17 million is not affordable to most buyers in America today. So non-luxury down 9.7% on total inventory and luxury up 13%. That tells a deeper story on the inventory. So I've been excited to report, hey, inventory looks like it's going up all of January. This kind of puts a dent in that excitement for sure. Digging into this Redfin data, it's just another way to look and analyze this inventory. It's also how I always think about this new construction market too. It's like, oh wow, we're building more homes. Well, are we building any affordable homes? No, we haven't been. We've been building homes well above the median price point. The decline in luxury sales now is shrinking. So here's an argument for prices to pull back in luxury, right? If the luxury sales are shrinking and inventory and new listings are shooting up, one would argue that you could see prices now either flatten out here this year or even go down. So luxury sales down 1.7%, non-luxury down 8.1% on year-over-year change in home sales. All of these charts are available for you in BAMX, so you can easily download them, as well as the show notes, which even here on this free format Friday, we've got great show notes, very robust show notes. Here are the 10 most expensive U.S. home sales in the fourth quarter of 2023. Let me know if your name was on one of these deals. Miami, Indian Creek Village, 79 million. New York, 75 million. New York, 65.6. Aspen, 60 million. New York, 47 million. So New York, Manhattan, three of the top five most expensive U.S. home sales in 2023. Then you've got Aspen. People trying to lock in those winter deals there in Aspen. San Francisco, Fort Lauderdale, Miami, and then Los Angeles make up the top 10 for most expensive U.S. home sales in the fourth quarter of 2023. Let's take a look at some of the luxury housing metro areas as reported here by Redfin. Anaheim median sale price of over $4 million. You had a 9.1% increase year over year there. Atlanta is more in line with the national high mark that was just set, just above that at 1.3, 10.8% year over year mark. Austin's near 1.7 million, but had an 8.6% drop. Baltimore, basically, even with the national number there at 1.125 million, 7.1% jump. Look at Boston, 2.2 plus with a 2.3% jump year over year. Charlotte comes in at 1.3. Now you see Cincinnati. This is what I mean. Every market's different. Cincinnati, Cleveland, Columbus. Those are in the 7s and the 8s for what is the median luxury, because these are all just the luxury properties, the median luxury home. So that top 5% of market value. Dallas at 1.4, Fort Lauderdale 1.6. Fort Lauderdale was up 8.7% year over year. Indianapolis, here's another example of what would be luxury in Indianapolis from a median standpoint, 849,000, and that's up 6.6% on the year. So Indianapolis has obviously been very popular for those median price points, the true median price point, but also showing popularity in the luxury market, up 6.6%. Kansas City, shout out to the Swifties, up 3.8% on the year. 869,000 is the median luxury there. Los Angeles 3.5 million, Miami 2.8 million, both up 3.7 and 8.7 respectively. Milwaukee's under $1 million for median luxury, but up 7.1% on the year. Minneapolis is just under $1 million, basically flat on the year there. Let's find some others that are under $1 million. Pittsburgh under $1 million for luxury. Pittsburgh doesn't strike me as a super luxurious market. By the way, never been. So complete ridiculous statement for me because I've got no context. But the steel curtain, blue collar town. Pittsburgh coming in median luxury at $750,000, down 2.2% on the year for luxury. San Antonio under $1 million at $950,000. 3.3% up on the year. San Diego, 3.2 million. San Francisco, 4.85 million and up 2.1% on that top 5% luxury. There you go. We've got this all linked up for you in BAM X. Easy for you to download everything, as well as the show notes right there to get the most out of everything we do at BAM. Use code HOT to get 10% off of BAM X. U.S. economy added 353,000 jobs in January. Much better than expected. Typically, this would be great news. I just said yesterday, I have to amend what I said yesterday because the estimate as of yesterday was, okay, we're not going to add many jobs here. But look at this. The 353,000 that came in was much better than the Dow Jones estimate for 185,000, according to the Labor Department's Bureau of Labor Statistics reported just this morning. The unemployment rate held at 3.7%. when the estimate was 3.8. So just yesterday, we're looking at reports saying, hey, January is going to be the lowest number of, job hires in quite some time and this kind of stuff. And it ended up not being accurate. Okay. Why that one might sound like a great thing. Oh my God, people are getting jobs. Well, not the case. Okay. Because when we look at what's happened here with the 10-year. It popped up back over 4% today. We're down here to 3.993, but you can see uh, you know, up 0.118 there on the 10-year and getting up over 4. You can see right here on the chart, if you're watching, 8:30 a.m., the 10-year popped from under 3.9 to over 4 instantly on the jobs report, okay? So a much stronger than anticipated jobs report has investors reacting here and has the 10-year shooting up. This is gonna be one of those nuggets of information that the FOMC, Jerome Powell, the Fed is going to say, like they indicated, on Wednesday afternoon, maybe we're not ready to cut rates in March because this can speak to, we've got a really stronger than expected job market. Could we see inflation tick back up? Could it start to speed back up in the future? That's what they're trying to bet against. Steve Harney, founder of Keeping Current Matters, of course, he tweeted out this morning, good news. The BLS report crushes expectations with an additional 353,000 new jobs. I agree with him. That's always good news. People getting jobs, people working is great news. The bad news was that the 10-year Treasury yield was back to 4, as I just showed you. Now back under 4, but did go back up and over. And so here's the punchline, and this is what I've been preaching here on the hot sheet all month of January. While there's some really questionable advice going around the internet, people telling consumers, hey, 5% rates are certainly coming this year. That's so far from a guarantee, it's not even funny. The bumpy road on rates continues. It's going to continue throughout this year. So stay away as an agent from promising lower rates to clients. It's a really good idea in this climate to stay away from promising or predicting a guarantee in lower rates coming. We're all rooting for it, and there's enough projections and analysis to suggest that it's certainly possible this year, but nothing in this economy is definitive, as we've seen in the first 31, 33 days of the year here throughout January. So be careful with how you talk about the rates. Here's what the projections and the analysis suggests, that we're going to, while we'll have bumps in the road, have a steadying decline throughout the year. What we've seen in the last 33 days is rates kind of bumping all over the place following that 10-year. If we just look at the last week alone on the 30-year fix, that shows you all the evidence you need to recognize that there's bumps in the road. We ended last week at 6.9 and we ended yesterday at 6.63. Okay. It's a full quarter point flip in just a week. We also ended the 30-year fixed weekly survey at the same number we ended yesterday on the daily at 6.63. Daily probably goes up today off of the 10-year news. All right. There's everything I got for this week. We've got a Knowledge Brokers podcast coming out today over on that channel at Knowledge Brokers Podcast at 2 p.m. We're going to break down a whole bunch of this stuff. We're going to talk the Keller Williams settlement. We're going to talk the link for the rates there. We've got it inside of BAMX. I believe all the links are always there for you to make it easy. But this is mortgagenewsdaily.com. You go to mortgage rates. And this is the best one because they've got the daily survey that comes out. So you see sometimes people always reporting on this Freddie Mac 30-year fixed weekly survey, which just came out yesterday, comes out on Thursdays. And that came in at 6.63. But the daily survey gives you a better indication of what's happening in that 24-hour time period. Sometimes there'll be one or two or even three. There's usually always one read, but sometimes there'll be two or maybe even three reads. They'll change it and adjust it based on, the news and the information that's hitting the economy on that given day. So yesterday came in and it ended the day at 6.63. Today's read will come out a little bit later. And based off the 10-year this morning, it'll unfortunately probably be higher for buyers going in into the weekend. But this is the best, most accurate source. Do not use Google for mortgage rates. And a lot of buyers do that because nobody's educated them, right? They're on Google and they just type in mortgage rates and some crazy number pops in. I mean, if we did it right now, if I go to I'll go to Google here. If we go to Google and just type in mortgage rates, I promise you it's going to be different from, look at this. 7.417 it says for the 30-year fixed. It's got me, I'm sitting in Connecticut right now, so it's got me there. Can I go to the United States? Curious what it would say for just the average across the country. America, where's America? Come on, people. I guess it's just going to give you the state, okay? But it's coming in at 7.417. We know the 30-year fixed daily survey yesterday was 6.63. So this is where people can get some misinformation. Obviously, the rate can depend on their personal situation. It could be much higher than 6.63. Depending on your personal financial situation. Okay, there we go. Rebecca, what's happening? Rebecca sent my investor client to the NBA. Do you think that's bad? No, I don't. To the NBA, to the Mortgage Banker Association. Not sure what you mean by that. To Mortgage Banker Association. I think that Mortgage Banker Association has great information. I'm not sure what you mean by that there, but okay, yeah, Mortgage Banker Association. I'd send people. We use Mortgage Banker Association here on the hot sheet all the time. So, anyways, we've got the Knowledge Brokers podcast today, 2 p.m. Go over to that channel. Make sure you hit subscribe. We're going to cover all the things that have happened this week, stuff that we didn't cover here on the hot sheet. If you've missed the Ryan Serhant one-on-one video, signing up for their newsletter for an investor, Rebecca, absolutely good news. You're telling them where to get a great resource. I think that's smart on you. If you've missed the Serhant podcast, go check that out. The feedback's been incredible. There's some really great business tactics there. If you haven't signed up for BAM Pro Bowl, we're gearing up. We talk about it in that podcast. We're gearing up for that this Wednesday, February 7th. It'll be, I promise you, it'll be a virtual event in real estate you've never seen before. The BAM Pro Bowl is going to have Super Bowl-like commercials that are funny, that are just downright hilarious. We have a national anthem. We have a halftime show. We have a post-event analysis. Serhant, Neil Dingra, David Childers, Jason Pantana, Gary Gold, Danielle Garofalo, Marie Lee, Jimmy Mackin, myself, the broke agent, actually agents, Amanda Bradford doing the national anthem. It's going to be an epic event. Make sure you sign up for that. It's totally free. It's on Wednesday, 12 Eastern to 3 Eastern. Of course, I'll remind you there on the hot sheet as well. And have a great weekend, folks. We'll see you back here tomorrow, 9:30 on the East, 6:30 on the West. I'll also see you at 2 o'clock over at Knowledge Brokers Podcast. Until then, of course, toodaloo.